How distressed is the bond market?
The bond market is in very good shape, particularly high yield. In fact, I would say, if anything, there is actually a supply scarcity of good quality high yield paper to buy. So we've had yield spreads widen out only 100 or 200 basis points more than the Treasury move. So high yield bonds year to date have far outperformed Treasuries investment grade. It's really more lack of supply for buyers to buy. And defaults are under 2%.
Michael Darda, in his weekend note, is heated that the market is wrong on higher. He's looking for inflation and rates will fall meaningfully. That's an opportunity for Margie Patel. Given a disinflation or price up, yield down, where's the best place to play?
In the bond market, I think that better quality high yield is a very good place, because if we have a real slowdown, if we have deflation, we may see defaults go from 2% to 4 or 5%, their historic average. So that says take a little bit of risk and say a double B name, get less yield, but you'll be able to keep it and not lose your principal if there are higher defaults.
How much are you looking at stocks underperforming next year? We got some outlooks from a number of Wall Street banks, and pretty much they are unanimous that next year is not going to be great for U.S. equities. Do you agree?
No, I really don't. I think it's really, at this point, up in the air. A lot depends on what the Fed does. If the Fed slows down their very rapid rate of increase, will that allow us to avoid a recession? I think on a relative basis, we'll still be better off than just about any other country in the world. And because people are so wary of this risk, that says to me maybe there's a lot of money on the sidelines that would like to come in if it looks as if the air is clearing and the Fed is stabilizing, or we miss a recession.
Can you do it at the headline index level, or do you have to be perhaps a little bit more sector specific based on what's happening in tech?
Well, I think you have to look at sectors. I think that technology has had a lot of problems. It's one of the big underperformers this year. But if you go back, say, to 2000 when the market crashed, tech was much, much more overvalued. The crash was much bigger. The recovery took much longer. This time, a lot of tech names, some of the semi-names, are very reasonably priced for their long-term growth. Still volatile, but the PEs are down closer to what the expected growth rate will be. So we think a lot of parts of the tech market is pretty attractive here.
Margie, you have been fearless about looking at equities for dividend growth and as an income trade. Is that true now?
I think so, because you've had such a big correction in equities. You really put the dividend yield, the cash flow yield, where it is actually competitive with investment-grade bonds. So if we have any kind of a growth in the economy next year, it says to me equities will outperform. I think 23 will probably be a rather muted total return year, but I still think equities will do better than bonds.